please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome to Halftime Report. It's 12 noon. We're halfway through the trading session. It's a perfect time to take you through the top stories of the day. I'm Reema Tendulkar. With me is Nigel D'Souza. Hi, Nigel.
Hi, Reema. Well, the markets are in the red today. We have more number of stocks that are declining than advancing. And the rupee, keep an eye out on the rupee. It's making that move towards that 67 odd mark. I think the intraday chart of the rupee should come up for you. We are seeing some weakness there. It's at the day's low. That's our ticker team alerting us, 66.7. So that's a multi-month low, in fact, we're seeing on the rupee. And obviously, we'll have to keep an eye out on some of those IT stocks because that could be a bit of a tailwind for them going ahead as well. We'll talk more about that. First up, running you through. Time for our movers and shakers segment. And let's start off with Bharti Airtel. Reema.
Well, multiple factors aiding the positivity on Bharti Airtel today. One, on the Q4 numbers, slightly better than what the street was anticipating. For one, they've reported a profit of 83 crore. Consolidated margins too ahead of street expectations, but the beat there is on account of the Africa margins. India wireless financials continue to remain challenging, with the company reporting an EBIT loss of 482 crore. The average revenue per user steadily declining and now down to 116 rupees per customer versus about 190, 195 that it had pre-Jio. But on the flip side, on account of all these cuts in pricing, the volume numbers are looking very strong, whether it's the voice volume or the data volume growth at 40%. These internal metrics are very strong. So that's on the Q4 numbers, which was a slight beat. DB says, which they have a buy call on the stock. They believe that the stock offers a valuation upside when the sector revenues recover, but that's still perhaps some time away given the cutthroat competition. Secondly, and the bigger reason for the up move could be the TDSAT ruling, which has provided relief. So the TDSAT has stayed the TRAI ruling on two key things. One, it penalized the operators for providing segmented offers, which basically means that segmented offering is when an operator was providing you offers or discounts only to a particular customer, not to everyone in the same tariff plan. And secondly, the TRAI had come out with a new definition of significant market player, an SMP, which was used to calculate whether the operator was providing predatory pricing. Now, the definition of SMP was seen positive for Jio and negative for Bharti, Idea and Vodafone. So that definition of SMP has been stayed, and therefore it's a relief for telcos. And thirdly, it's also this big merger in the tower space, Bharti Infra with Indus. Now, Bharti, which is a majority shareholder in Infratel and had a 42% stake in Indus in the combined entity, they will have about a 37% stake. But Bharti's plan is to monetize this stake and look at selling it to a PE player and get in money. And finally, this stock was one of the worst performing stocks in 2018, having fallen about 20%. Even after the 5% gain today, it's still down about 20% in 2018. So it's moving up on fallen values.
Okay, all right, Reema, thanks so much for that. But let's get to the stock of the last couple of days. ICICI Pru. Abhishek's with us. Abhishek, those numbers came out today that appears brokerages as well. They're quite positive on the stock.
Well, Nigel, entire list of brokerages that we are going to run through have turned positive on the stock with either a buy or an overweight rating. So what the analysts on street are estimating is that they are positively surprised by the fact that value of new business margin has come in at 16.5%. Now, this value of new business margin actually measures the profitability of the new business that is flowing into the company. So even if you remove this one-off of tax exemption, the value of new business margin is at 15.2. That compares to about 10.1% on a YOY basis and 13.7% on a sequential basis. They are also positively surprised that an annualized premium equivalent growth has now turned positive. That grew about 40% on a sequential basis. And this growth in annualized premium equivalent was largely led by protection mix. So they expect that leverage to improve the margins are there as annualized premium equivalent has turned positive. That is led by, protection mix, and also persistency ratio are sticky. So the CLSA, Nomura, Credit Suisse, Morgan Stanley, Prabhudas Lilladher all have the target price ranging between 515 to about 570 rupees per share. Let's listen into what the management have to say about their results.
We believe on a long-term basis, India offers great opportunity on the savings side as well as protection. Savings largely on the back of financialization of savings, and protection because of under-penetration. We do believe that the savings business over a longer term will grow ahead of the nominal GDP, and we will grow marginally ahead of that. And that's the view we have been saying consistently, and we maintain with that. We are as excited about this business today as we were a couple of years back. From a shareholder perspective, we are focused on increasing the value of new business. As I mentioned, we had increased it significantly during the course of the year, and this will be a function of product mix and growth. Protection this year was about 4.46 billion compared to about 2.6 billion in FY17, so it has grown by about 70-odd%. So I think the focus will remain on protection. Focus will also remain on savings. The opportunities are different. We are equally committed to the savings business as well as the protection business. So as you did point out, protection has a little more higher margin than the savings business. If protection grows at a faster rate than savings, obviously the margin will improve.
Well, Gati, it's been the stock over the last couple of days. It's been a big mover. Mangalam joins in with his analysis of the same. Mangalam.
Well, Nigel, you know, the stock has moved quite a bit, about 30-35% in this week itself. But there are a couple of points which really stand out. The company informed the exchanges that the board will meet tomorrow to consider fundraising or the possibility of a strategic investor coming on board. And why is the street excited? Well, because of four things. One, despite the up move on the stock, it's still off its 52-week high. The 52-week high was closer to around that 150, 151 levels in January itself. The company's been doing fairly well. The market cap of close to around 1,400 crore rupees means that the profitability that the company incurred in the first 9 months of this year, 47 crores as against 22 crores. If that extends to 60 crores, the company is offered at around 22-23 times FY18 earnings. And we need to keep an eye out on the fact that the debt, while it's 333 crores as of September, the 9-month finance cost has come down as well. So operationally, the business looks good. However, the big concern, of course, was the promoters' stakeholding and the pledge. So as of last June, the promoters held closer to that 29% mark with 80% stake pledged. And seems that the pledge holders have invoked their pledge, and subsequent quarters, we've seen the promoters' stake come down and the pledge also come down. So the promoters' stake less than 25%, of which 78% is still pledged, will make for this meeting for all the more increase all the more possibilities of strategic partners coming in and perhaps buying out some of the promoters' part as well. So we'll keep an eye out on that. Nimesh earlier, remember, broke that Kinsetsu, the Japanese company which holds 4% stake in the company, is likely to be inducted as the strategic partner, likely to increase their stake. So a meeting that the street will be watching out for.
47% rally in the month of April so far for Gati. Thanks, Mangalam, for that. That would put the spotlight on TCI Finance.
Yeah, that's right, Rima. Just a quick spot to there. TCI Finance, it's a small company. It's listed on the BSE. The market capitalization's roughly around, around 40 crores, now 42 crores approximately. The stock is up today 4.5%. In this week itself, that's in the last couple of days, it's up close to around 15% odd. Why are we looking at it? It has 4.3% stake in Gati. The current market cap, as I said, is only 42 crores, but that 4% stake in Gati is valued at around 62 crores, and that could explain why, in fact, the stock has seen a bit of a run in the last couple of days. 9% is what it's showing, but in the last couple of days, it's up more than 10%. But let's talk about Indico Remedies. Not too good news coming in for Indico Remedies. Ekta was here. She has been highlighting that particular story. Ekta.
Yes, absolutely. Well, the UK MHRA has now given a non-compliant certificate to Indico Remedies Unit 1 in Varna. So now, just to put it into perspective, this particular inspection had taken place by the UK MHRA in March of 2018. They had given 7 observations totally, and there were 3 critical observations of that. Now, after this particular inspection took place, now this particular inspection has escalated by the UK MHRA into a non-compliant certificate. They have pointed out the 3 critical observations in this particular inspection. So that included evidence of falsification of data, Plus, pharma quality system was ineffective, and there were false and misleading statements which were provided to inspectors as well. So what happens now is that no batches of non-critical products are to be supplied to the EU markets while this statement of non-compliance is enforced by the UK MHRA on this particular facility. So that's the reason why the stock is down 7% because this particular observations and inspection has now escalated to a non-compliance certificate. I also want to point out that these are not the only issues which are faced by Indico Remedies. Their Unit 1 was inspected by the US FTA and issued 8 observations in Jan 2018, and the Unit 2 and 3 in Goa are under a warning letter from the US FTA since March of 2017.
Okay, Ekta, thank you very much for that. Zensar Technology is also marginally higher. In Q4, the margins disappointed the street, but the management is betting big on their digital portfolio and they expect the momentum there to continue. Listen in to Sandeep Kishore, the MD and CEO of the company.
Digital is the main pivot for our growth. I mean, if you take a look at over the last 2 years at Zensar, what we have been driving, we've almost doubled our digital business. So we are now running, at about $50+ million on a quarter for digital business. And I do feel based on the pipeline that we have and all the platforms that we have developed in Zensar, that you should see a, momentum of 8+% sequentially on the digital business. If you've seen the trending in fiscal 17, year on year, we actually grew by about 1.5%, fiscal 18 by about 5.8%. So we are pretty confident that you will see a higher growth than what we have delivered last year into fiscal 19.
Well, Tejas Networks is a stock on our radar. Remember, the company posted a rather weak quarter despite a guidance cut. Earlier, we spoke to Mr. Sanjay Nayak, the MD and CEO of the company. He sounded optimistic of a better FY19.
We have said that a 20% CAGR on a medium-term basis, which is a 3-year basis, is what we had seen happening for us. And we believe that we will continue to do that. So we did have a shortfall in last year. The current financial year, we should be able to make up for the shortfall of last year. There are a lot of orders which we are either L1 or where we are very close to bagging from the customer, which should all come back and add to the growth momentum that we are seeing.
Okay, and Persistent Systems too, on expected lines, has posted a weak Q4. That's because their IP business took a hit in the quarter gone by. But the management, Anand Deshpande, the founder, MD and CEO of the company, is bullish on improving the margins from here on. Listen in.
The improvement in margins is not going to be because of utilization improvement. It is going to be because of improvement in what we are able to charge our customers. Over the year, I think about 3 to 4% increments in rates have happened across the board. But again, they are not all like-to-like comparison because the mix of business has been changing as you go along. And the newer digital business that we have comes in at a better rate structure than the previous old business that we have.
Okay, then here's a quick recap of all the buzzing stocks we just covered. We have Bharti Airtel, ICICI Prudential, Gati, Indico Remedies, Zensar Technologies, Tejas Networks, as well as Persistent Systems. And a few stocks that are in focus as we speak. Bharat Forge has moved to the high point of the day, so I think we should keep an eye out on that stock. And yesterday, we did see some of these stocks like Reliance Communications, Reliance Naval. They were under some pressure. Today, they're opened up in the green. Take a look at what's happened in the last few minutes. All of them have moved to the low point of the day. Even Reliance Naval should come up for you. Sharp downtick in the last few minutes. But plenty of earnings expected today. Wipro will be one stock that will be in focus on the back of its Q4 earnings. Rima, what are you expecting there?
Well, for one, remember, Wipro has been an underperformer. It's underperformed the Nifty IT by nearly 25% since the start of the year. This quarter, we're expecting growth rates similar to that of the industry. So dollar revenue growth at 2.7%. In constant currency terms, it should be a growth of 1 to 1.3% versus a guidance of 1 to 3%, which means the constant currency growth will be closer to the lower end of the company's guided band. And again, as we said, growth will be similar to what its peers have reported. Infosys constant currency revenue growth was about 0.6%, whereas TCS was 2%. Margins will be, optically will appear higher at 17.4%, which would compare with 14.8%. But this will be on an adjusted basis. If you look at it, it will be 17.4 versus 17.2%. That's because in the prior quarter, there was a provisional write back. The company had also issued a profit warning for Q4 because of one of its telecom clients filing for bankruptcy. So we understand that's going to be Airtel. So there will be an impact on account of that. So we'll see how it gets adjusted. The key will be the guidance for Q1 FY19. The guidance is seen at 0.5 to 2.5%. Many people on the street believe it could be even 0 to 2%. But remember, Q1 is a seasonally weak quarter for the company. The key to track will be when can the company get back to the industry growth rates on a sustainable basis. That's going to be the key factor to watch. Secondly, do they continue to maintain their guidance on constant currency? Their earlier guidance was they will maintain constant currency margins in a narrow band for the full year. In the prior quarter, they had indicated that with respect to calendar year 18 and 19, the management feels quite optimistic in terms of the next year compared to this year. Do they continue with that optimism? Contribution of digital, continued growth in their BFSI portfolio, a pickup in momentum in healthcare, which is now bottomed out and started to show some growth, will be factors to watch. But that's not all. We will be tracking Ultratech Cement as well, Nigel.
Yeah, that's right, Rima. In the next couple of hours, I'm expecting Ultratech Cement to come out with their set of numbers. Well, let's run you through the details. And on the top line, we're going to be expecting a strong growth. 28 to around 29% is the growth that we're working with in terms of revenue growth. That's going to be led because sales volumes are likely to come in higher by roughly around 28% or thereabouts. We're working with a number of around 17.5 million tons. That's telling you your top line is growing by 29%, but your sales volume is growing by 28%. So realization should contribute only around 1% in terms of growth to the top line. Remember, realizations have been more or less flattish, and that in fact has been a bit of a disappointment. But you'll see why we're seeing such a big increase on the top line. That's because of consolidation of JP Cements, the newly acquired JP plants in their business. So that's why in fact, there's going to be a big growth on the top line because there's so much more capacity that's added. But that comes to the flip side as well. It'll help the top line, but in terms of margins, there'll be a bit of a compression. Why? Because JP Cements, remember, the profitability is not as good as Ultratech. That's point number one. Point number two is that realizations are more or less flattish. And point number three, you have flat realizations and your input costs have gone up. So pet coke prices have gone up, diesel prices as well have gone up. That's what explains margin compression of roughly around 200 to around 220 basis points odd. The profit number as well should contract by around 20%. That's because, in fact, of the consolidation of the newly acquired JP Cements assets in their books. So interest costs will be higher, depreciation costs as well will be higher. More or less, it'll be a mixed set of numbers that we are expecting, but also watch out very, very closely for how is the newly acquired JP Cements, the ramp up happening with them. In the first quarter of this year, it was roughly around 15%. The management said that that particular newly acquired asset will ramp up to around 60%. So we'll keep an eye out very, very closely in terms of the capacity utilization there. But that's not all. From the pharma space, Syngene will be coming out with its set of numbers. Ekta is with us. Ekta, run us through the expectations.
Well, it's already been quite an outperformer in terms of its stock. Syngene is up around 20% on a year-to-date basis. Now, what we are expecting this quarter for Syngene is the kind of earnings trajectory that we saw last quarter to continue into this quarter as well. So it's expected to grow around 15% on a year-on-year basis in terms of the top line, which would be led by their verticals such as their discovery services vertical. If you're talking about the margins were at around 32% last quarter, and that sort of margin performance is expected to continue into this quarter as well. So the estimates are around 30% for margins this quarter. Now, it'll be interesting to note in terms of the commentary. We did speak to the management recently with regards to a couple of new clients that they've got on board. So what the commentary would be on the new clients, as well as what the position would be with the fire which had taken place in the previous fiscal and the insurance claims, etc. But otherwise, Biocon would also be impacted on account of these numbers, because remember that Syngene is the research arm of Biocon, so their numbers are consolidated into Biocon as well.
Okay. Thank you, Ekta, for all those details. By the way, there's a sharp fall in Wipro as we speak ahead of numbers. So Wipro has seen a cut of close to about 1.5% just in the last few minutes. Let's get the intraday up for you of Wipro. There you can see a sharp slide. Numbers will be out today. And the stock is just about holding up in the green.